This was the first of 2 days of hearings about the failure of Silicon Valley Bank and the role of federal regulators in all of this. We'll hear more in a moment about how lawmakers from both parties criticized top officials today. But first, let's break down some of the basics behind the second largest bank failure in U.S. history. Economics correspondent Paul Salman is our guide.
The collapse of Silicon Valley Bank. First, what happened?
SVB is a large bank that essentially failed.
And why, I asked economist Dana Peterson.
First of all, it was highly concentrated in an industry, the tech sector, that's really not doing that well right now.
And the depositors were?
Many of the folks who were invested in SVB were very high net worth individuals, meaning they had tons of money. And you also had a number of startup companies in the tech sector. So you had companies that need money for payroll and cash.
Of course, banks usually love such depositors, but SVB didn't have enough corporate or individual borrowers to loan the money to. What does a bank do then?
You can lend to the government. I mean, Uncle Sam and Auntie Sammy is very happy to borrow from the public, and they pay decent rates of interest.
Interest on Sam and Sammy's IOUs, that is, their government bonds. But that was a few years back. Then the tech sector turned sour, and the depositors had to start withdrawing their money. To come up with the cash, SVB had to sell some of those bonds, guaranteed safe by the government. But, says Johnson,
problem is, Paul, there is interest rate risk, which means as interest rates go up, the value of the bonds go down.
This is often confusing, so I asked, why, when interest rates go up, does the value of bonds go down?
It's the value of the old bonds, the bonds that were issued at a previous interest rate, Paul, because now the government is borrowing, paying a higher interest rate.
Now, I thought this might benefit from a bit of show and tell at the Treasury itself. Simple when you stop to think about it. The bank had bought billions of dollars of U.S. Treasury bonds at a low rate of interest. Suddenly, it had to sell some to come up with the cash to pay off fleeing depositors. Meanwhile, interest rates had gone up. Today's bonds are paying a much higher rate of interest than these. So, which would you rather have? Obviously this one, which means this one's worth less, the price goes down, the bank loses money. And, says Simon Johnson,
depositors thought about that, noticed it in some fashion, and decided to pull out even more money.
And that's what happened.
And then the run was on.
All right, now what happened? How did it start?
Well, how does a thing like this ever start? All I know is the bank called our loan.
When?
About an hour ago, I handed over all our cash.
All of it?
Every cent of it.
Now, just remember that this thing isn't as black as it appeared.
It's a classic Jimmy Stewart story, and it's a wonderful life.
As former FDIC Chair Sheila Bair told Jeff last week,
we've all seen that, right? When the depositors went in and ran the bank and the money had been invested in mortgages, they didn't have all the cash. No bank does. Every bank lends out some of their deposits or makes investments with some of their deposits.
I'll take mine now. No, but you're thinking of this place all wrong, as if I had the money back in a safe. The money's not here.
The bank has made loans. If the depositors are withdrawing their money, either you call in the loan, or if you can't do that, you can't pay the depositors. Either way, the bank is in serious trouble and may not survive.
So then, who done it? Well, several suspects. SVB taking more deposits than they could profitably put to work and putting them all in one basket, long-term bonds. Quick trigger depositors. Inflation that hiked interest rates, killing the value of long-term bonds. And, say the likes of Senator Elizabeth Warren, loosening regulation, starting back in 2018.
We need to learn from what has just happened with these banks and go forward by tightening the regulations. It's just that simple.
Simon Johnson agrees.
I think loose regulation was very important, in part because, and this is what was said by the top Fed official at the time, it changed the tone of supervision. And Silicon Valley Bank was clearly very poorly supervised.
So what's the fix? David Wessel from the Brookings Institution.
The fix was that the Federal Deposit Insurance Corporation, with the permission of the Treasury Secretary, invoked a special provision of law and said that they would stand behind the deposits of every depositor at Signature Bank and Silicon Valley Bank, even if they had a lot more than $250,000 in the bank.
Good afternoon.
And the Federal Reserve also rode to the rescue.
You've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools. And I think depositors should assume that their deposits are safe.
So we're at the Federal Reserve. What's the Fed's role in all this?
The Federal Reserve is a lender of last resort. So when the banks got in trouble, they lent hundreds of billions of dollars to the banks.
Okay, the key question, what's the future hold?
The economy was already slowing down, partly because the Federal Reserve has raised interest rates a lot. But now, the banking crisis is probably going to slow it further. Banks are going to be more reluctant to lend. That means less borrowing and less spending in the economy.
But that's what the Fed wanted to begin with, slow down the economy.
Absolutely. As Jay Powell, the Fed chair, said in his press conference the other day, the credit crunch that's caused by the banking crisis is some way going to substitute for interest rate increases.
And thus, concludes Wessel,
the Fed won't have to raise interest rates so much.
Because the banking crunch may or may not squash inflation on its own. For the PBS NewsHour, Paul Salman in Washington.